Question 1. An individual who provides advice regarding securities for compensation and also affects transactions for clients is best described as A. Broker-dealer. B. Investment advisor. C. Investment advisor representative. D. Transfer agent. Answer: B. Investment advisor. An investment advisor is defined under the Uniform Securities Act, and Investment Advisors Act of 1940, as a person who, for compensation, engages in the business of advising others as to the value of securities or the advisability of investing in, purchasing, or selling securities. While broker-dealers effect transactions, and investment advisor representatives work for investment advisors, only the investment advisor combines the elements of providing advice for compensation as a business and often affecting transactions. Think of an investment advisor as a financial coach who charges for their expertise in guiding investment decisions. Question 2. Under the Uniform Securities Act, which of the following actions by an investment advisor is considered an unethical business practice? A. Charging a reasonable advisory fee for services rendered. B. Recommending a security suitable for the client's objectives. C. Exercising discretion in a client's account without prior written authorization. D. Providing a performance report that complies with GIPS standards. Answer: C. Exercising discretion in a client's account without prior written authorization. Investment advisors typically require written discretionary authority from a client before they can make investment decisions, like buying or selling securities, on the client's behalf without specific, prior approval for each trade. Acting without this written authorization is a serious breach of fiduciary duty and an unethical business practice, as it removes the client's control over their assets. Always remember that discretionary authority requires explicit written permission, often through a power of attorney or a specific discretionary agreement. Question 3. A client is concerned about outliving their retirement savings and seeks an investment vehicle that will provide a guaranteed income stream for life. Which of the following would be most suitable for this client? A. A growth mutual fund. B. A deferred variable annuity. C. A single premium immediate annuity, SPIA. D. A municipal bond fund. Answer: C. A single premium immediate annuity, SPIA. A single premium immediate annuity, SPIA, is designed to provide an immediate, guaranteed stream of income payments, typically for the life of the annuitant, in exchange for a lump sum payment. This directly addresses the client's concern about outliving their savings by turning a lump sum into a predictable income stream. While a variable annuity offers growth potential, it's a deferred product, and a growth mutual fund or municipal bond fund do not provide guaranteed income for life. Question 4. When analyzing a company's financial statements, an analyst calculates the earnings per share, EPS. This metric is primarily found by examining the company's A. Balance sheet. B. Income statement. C. Statement of cash flows. D. Statement of retained earnings. Answer: B. Income statement. Earnings per share, EPS, is a profitability measure that indicates how much net income a company has earned per share of common stock outstanding, and net income, also known as profit or earnings, is the bottom line figure on a company's income statement. The income statement summarizes a company's revenues, expenses, gains, and losses over a period, ultimately leading to net income. Remembering that income is in the name income statement can help link it to earnings calculations. Question 5. An investment advisor has a fiduciary duty to their clients. This means the advisor must: A. Always generate the highest possible returns for the client. B. Place the client's interests before their own. C. Guarantee the client against investment losses. D. Trade frequently to maximize commission income. Answer: B. Place the client's interests before their own. A fiduciary duty is a legal and ethical obligation to act solely in the best interests of another party. For investment advisors, this means prioritizing the client's financial goals and well-being above all else, including any potential personal gain or conflicts of interest. This duty is the cornerstone of the client-advisor relationship and guides all recommendations and actions. Question 6. Which of the following is typically excluded from the definition of an investment advisor under the Investment Advisors Act of 1940? A. An individual who charges a fee for providing financial plans. B. A bank that advises clients on investments. C. A person who publishes general financial newsletters for a subscription fee. D. A financial planner who actively manages client portfolios. Answer: B. A bank that advises clients on investments. Under the Investment Advisors Act of 1940, banks are specifically excluded from the definition of an investment advisor, even if they provide investment advisory services for compensation. This exclusion acknowledges that banks are already heavily regulated by other federal and state banking authorities. Financial planners, publishers of general advice, if their advice is not tailored to specific clients, and individuals charging for financial plans would typically fall under the definition unless another exemption applies. Question 7. During which phase of the business cycle would you typically expect to see rising inflation and increasing interest rates? A. Contraction. B. Trough. C. Expansion. D. Peak. Answer: C. Expansion. During the expansion phase of the business cycle, economic activity is increasing, consumer demand is strong, and businesses are growing, which can lead to upward pressure on prices, inflation, as demand outstrips supply. To combat rising inflation and cool down an overheating economy, central banks like the Federal Reserve typically raise interest rates, making borrowing more expensive. Think of an expanding economy like a growing fire that eventually needs more fuel and potentially more water to control. Question 8. An investor is concerned about the impact of a sudden market downturn affecting the value of their diversified portfolio. This type of risk is known as A. Business risk. B. Specific risk. C. Unsystematic risk. D. Systematic risk. Answer: D. Systematic risk. Systematic risk, also known as market risk or non-diversifiable risk, is the risk that affects all investments in the market due to macroeconomic factors, such as recessions, interest rate changes, or major geopolitical events. It cannot be eliminated through diversification, as it is inherent to the overall market. Unlike unsystematic risk, which is company-specific and can be diversified away, systematic risk is a broad market phenomenon. Question 9. An investor expects a significant increase in the price of ABC stock and wants to profit from this anticipated rise with limited capital. The investor should consider A. Buying a call option on ABC. B. Buying a put option on ABC. C. Selling a call option on ABC. D. Selling a put option on ABC. Answer: A. Buying a call option on ABC. A call option gives the holder the right, but not the obligation, to buy a specified number of shares of the underlying asset at a predetermined price, the strike price, on or before a certain date. If the investor expects the stock price to rise, buying a call option allows them to profit from this increase while limiting their potential loss to the premium paid for the option, making it a suitable strategy for bullish sentiment with limited capital. Question 10. Which of the following bond characteristics is inversely related to market interest rates? A. Coupon rate. B. Par value. C. Maturity date. D. Market price. Answer: D. Market price. The market price of an existing bond moves inversely to current market interest rates. When interest rates rise, newly issued bonds offer higher yields, making older bonds with lower coupon rates less attractive, and their market prices will fall to compensate for the lower yield. Conversely, when interest rates fall, existing bonds with higher coupon rates become more attractive, and their market prices will rise. This relationship is crucial for understanding bond valuation. Question 11. Which of the following individuals would most likely be required to register as an investment advisor representative, IAR? A. A receptionist who answers phones at an advisory firm. B. An administrative assistant who handles client paperwork but does not provide advice. C. A partner in an investment advisory firm who supervises employees and provides investment advice to clients. D. A person who publishes a weekly general market commentary in a local newspaper. Answer: C. A partner in an investment advisory firm who supervises employees and provides investment advice to clients. An investment advisor representative, IAR, is an individual who works for a registered investment advisor and performs functions such as providing investment advice to clients, managing client accounts, soliciting advisory clients, or supervising employees who perform these services. A partner who both supervises and provides advice clearly falls under this definition. Remember, the key is performing advisory functions or supervising those who do. Question 12. Under the Uniform Securities Act, if an investment advisor takes custody of client funds or securities, which of the following is typically not a requirement? A. Notification to the administrator. B. Segregation of client funds from firm assets. C. Annual surprise audits by an independent public accountant. D. Maintenance of a minimum net capital of $50,000. Answer: D. Maintenance of a minimum net capital of $50,000. While investment advisors with custody do have specific net worth/capital requirements, the $50,000 figure is generally associated with broker-dealers or specific state-level IA requirements, not a uniform federal standard for custody that applies to all IAs. However, notifying the administrator, segregating client funds, and undergoing annual surprise audits by an independent public accountant are common and strict requirements for investment advisors who maintain custody of client assets to protect against misuse and ensure accountability. Question 13. Form ADV, Part 2A, the brochure, primarily provides clients with A. A list of all securities held in the advisor's own portfolio. B. Detailed financial statements of the investment advisor. C. Information about the advisor's services, fees, disciplinary history, and conflicts of interest. D. Performance reports for all client accounts. Answer: C. Information about the advisor's services, fees, disciplinary history, and conflicts of interest. Form ADV, Part 2A, also known as the brochure, is a crucial disclosure document that investment advisors must provide to their clients. Its purpose is to give prospective and current clients comprehensive information about the advisory firm, including its business practices, types of services offered, fee schedules, any disciplinary events, and potential conflicts of interest. This ensures transparency and helps clients make informed decisions about engaging an advisor. Question 14. An investment advisor explains to a client that $1 today is worth more than $1 in the future. This concept is known as A. Present value. B. Future value. C. Time value of money. D. Compounding. Answer: C. Time value of money. The time value of money, TVM, is the fundamental principle that a sum of money is worth more now than the same sum will be at a future date due to its potential earning capacity. This is because money can be invested and earn a return over time, or inflation can erode its purchasing power. Understanding TVM is critical for financial planning, as it underlies concepts like future value, what an investment will be worth, and present value, what a future sum is worth today. Question 15. A client wishes to transfer assets to beneficiaries upon their death while avoiding probate and maintaining privacy. Which estate planning tool would be most suitable? A. A will. B. A revocable living trust. C. A durable power of attorney. D. A guardianship. Answer: B. A revocable living trust. A revocable living trust allows assets to be transferred to the trust during the grantor's lifetime, managed by a trustee for the benefit of beneficiaries. Upon the grantor's death, the assets in the trust typically pass directly to the beneficiaries according to the trust's terms, bypassing the public and often lengthy probate process. This structure also offers privacy, as the trust document does not become public record like a will. Question 16. For tax purposes, which of the following refers to a gain or loss on an asset that has been held for 1 year or less? A. Long-term capital gain/loss. B. Short-term capital gain/loss. C. Ordinary income. D. Qualified dividend. Answer: B. Short-term capital gain/loss. In taxation, an asset held for 1 year or less before being sold results in a short-term capital gain or loss. These gains are typically taxed at the taxpayer's ordinary income tax rates, which are often higher than the preferential long-term capital gains rates. This distinction is important for investors because the holding period directly impacts the tax treatment of their investment profits or losses. Question 17. The concept that an optimal portfolio can be constructed by combining a risk-free asset with a portfolio of risky assets is central to A. Efficient market hypothesis. B. Random walk theory. C. Capital asset pricing model, CAPM. D. Behavioral finance. Answer: C. Capital asset pricing model, CAPM. The Capital Asset Pricing Model, CAPM, describes the relationship between systematic risk and expected return for assets, particularly stocks. A core tenet of CAPM is the idea of the capital market line, which suggests that investors can optimize their portfolio by combining a risk-free asset with a perfectly diversified market portfolio, leading to the highest possible return for a given level of risk. This differs from efficient market hypothesis, which focuses on information reflecting in prices, and random walk theory, which describes unpredictable price movements. Question 18. A client is concerned about protecting their income in the event they become unable to work due to illness or injury. Which type of insurance would an investment advisor typically recommend for this concern? A. Term life insurance. B. Whole life insurance. C. Long-term care insurance. D. Disability income insurance. Answer: D. Disability income insurance. Disability income insurance is specifically designed to replace a portion of an individual's earned income if they become disabled and are unable to work due to illness or injury. This directly addresses the client's concern about protecting their income stream during periods of inability to work. While life insurance protects beneficiaries in case of death and long-term care insurance covers costs of chronic care, neither directly replaces lost income due to disability. Question 19. A company's assets, liabilities, and owner's equity at a specific point in time are reported on the A. Income statement. B. Statement of cash flows. C. Balance sheet. D. Statement of retained earnings. Answer: C. Balance sheet. The balance sheet is a financial statement that provides a snapshot of a company's financial position at a single point in time. It adheres to the fundamental accounting equation, assets equals liabilities plus owner's equity. This statement gives investors a clear picture of what a company owns, assets, what it owes, liabilities, and the residual value belonging to its owners, equity. Question 20. Which of the following statements about variable annuities is false? A. They offer a guaranteed rate of return on the underlying investment options. B. The value of the annuity can fluctuate based on the performance of subaccounts. C. They typically have surrender charges if withdrawn early. D. They offer tax-deferred growth of earnings. Answer: A. They offer a guaranteed rate of return on the underlying investment options. Variable annuities do not offer a guaranteed rate of return on the underlying investment options. Their value fluctuates based on the performance of the selected subaccounts, which are similar to mutual funds. This investment risk is borne by the annuitant. While they offer tax-deferred growth and often have surrender charges, the lack of a guaranteed return on the investment itself is a key characteristic that distinguishes them from fixed annuities. Question 21. Which of the following best describes the tax status of a limited partnership? A. Taxable as a corporation. B. Tax-exempt. C. A pass-through entity. D. Subject to double taxation. Answer: C. A pass-through entity. A limited partnership is typically a pass-through entity, meaning that the partnership itself does not pay federal income taxes. Instead, the income, gains, losses, deductions, and credits are passed through directly to the individual partners, both general and limited, who then report their share on their personal income tax returns. This avoids the double taxation common with C corporations, where the corporation is taxed on its profits and shareholders are taxed again on dividends. Question 22. According to the Investment Advisors Act of 1940, which of the following is not a required element of an investment advisory contract? A. The contract must be in writing. B. The contract must disclose the compensation arrangement. C. The contract must specify the types of services to be provided. D. The contract must guarantee a minimum rate of return to the client. Answer: D. The contract must guarantee a minimum rate of return to the client. Investment advisory contracts are strictly prohibited from guaranteeing clients a specific rate of return or guaranteeing against loss. Such guarantees are considered fraudulent or misleading practices because investment returns are inherently uncertain and depend on market performance. While contracts must be in writing, disclose compensation, and detail services, guaranteeing returns is explicitly forbidden. Question 23. An investment advisor, IA, registered with the SEC is required to register with a state administrator if A. They have a principal office in that state. B. They manage assets of $100 million or more. C. They have no place of business in the state but have more than 5 retail clients who are residents of that state. D. They advise only institutional clients in that state. Answer: C. They have no place of business in the state but have more than 5 retail clients who are residents of that state. Under the de minimis exemption provided by the Uniform Securities Act, an SEC-registered investment advisor, or a state-registered IA, generally does not need to register in a state where they do not have an office if they have no more than 5 retail clients who are residents of that state within a 12-month period. If an IA has more than 5 retail clients in a state without a physical office there, registration with the state administrator is typically required, triggering state registration. Question 24. Which of the following is considered a component of the primary market? A. Trading of previously issued securities on the New York Stock Exchange. B. An initial public offering, IPO, of a new company's stock. C. Trading of mutual fund shares in the secondary market. D. Over-the-counter trading of existing corporate bonds. Answer: B. An initial public offering, IPO, of a new company's stock. The primary market is where new securities are issued and sold for the first time by corporations, governments, or other entities to raise capital. An initial public offering, IPO, is a classic example of a primary market transaction, as it involves a company selling its stock to the public for the very first time. In contrast, the secondary market involves the trading of existing securities between investors. Question 25. An investment advisor becomes aware that a client has provided inaccurate information regarding their financial situation to qualify for a particular investment. The advisor should: A. Ignore the inaccuracy if the client insists on proceeding. B. Correct the information and ensure the investment remains suitable for the client's true financial situation. C. Disclose the inaccuracy to other clients to warn them. D. Report the client to regulatory authorities immediately without further action. Answer: B. Correct the information and ensure the investment remains suitable for the client's true financial situation. An investment advisor has a fiduciary duty to act in the client's best interest, which includes ensuring that all recommendations are suitable based on accurate client information. If inaccurate information is discovered, the advisor must correct it and reassess the suitability of any recommendations or existing investments for the client's actual financial situation. This upholds the advisor's obligation to put the client's interests first and maintain accurate records.